This is not a drill. This is not speculation. This is happening right now, and it has never happened before in the modern history of the United States Mint. On January 13th, 2026, the United States Mint sent out an official notice to customers that will go down in history as one of the most significant moments in the precious metals market. They have suspended all sales of silver numismatic products. Not delayed, not limited, suspended. Let me read you exactly what they said, because every word matters. Quote, "Due to metals cost, pricing adjustments are being evaluated across all numismatic products. In addition, rapidly rising silver prices may result in silver numismatic products being temporarily removed from sale while pricing is updated." Now, if you don't understand what this really means, let me translate it for you. The official mint of the United States just confessed that they cannot keep up with silver prices. They cannot price their products fast enough. The market is moving so violently that they had to pull everything off the shelf. Today, January 14th, silver is trading at $91 per ounce. Just 12 months ago, it was at $29. That's a 180% gain in 1 year, and the US Mint just blinked. In the next 25 minutes, I'm going to show you exactly what this means, why this is different from anything we've seen before, what happened the last time supply got this tight, and what you need to understand about the physical silver market that's about to break. Because what you're witnessing right now is not a top, it's a supply stress signal, and by the time this makes mainstream headlines, it will be too late. Before we go any further, you need to understand what the US Mint is and why this matters so much. The United States Mint is not a private dealer, it's not a speculator, it's not some guy selling coins on the internet. It is the official coin production facility of the United States government. They have been operating since 1792. Their job is to manufacture circulating coinage and produce numismatic products for collectors and investors. When it comes to silver, the Mint produces several products. The most famous is the American Silver Eagle, which has been in production since 1986. They make proof versions, uncirculated versions, and bullion versions. Each contains 1 troy ounce of 99.9% pure silver. Here's the key difference between the Mint and paper silver markets like COMEX futures. The Mint sources real, physical silver. They have to acquire actual metal, bring it to their facilities, strike the coins, package them, and sell them. They cannot just create paper contracts and settle in cash. They deal in physical reality. So when the Mint says prices are moving too fast and we need to pull products to reprice them, what they're really saying is we cannot acquire silver at prices that make sense anymore. The paper price you see on your screen is disconnected from the physical market. We're getting squeezed. Think about what this means. The United States government, with all its resources and connections, cannot accurately price silver right now. Let that sink in. The Mint doesn't speculate, they don't trade, they don't try to time markets, they simply respond to demand and try to sell products at fair prices based on underlying metal costs. For them to halt sales means the market has moved beyond their ability to manage. This has never happened in this way before. Yes, in the past, they've temporarily paused individual product releases to adjust pricing when silver spiked. But to send out a blanket notice warning that all silver numismatic products may be pulled, that's unprecedented. Now let me show you just how broken the pricing has become, because this is where it gets really interesting. As of today, January 14th, the spot price of silver on COMEX is around $77 per ounce, but that's just the paper price. Let me show you what's happening in the physical market. According to recent reports, physical bullion dealers in the United States are pricing the Mint's 1 ounce American Silver Eagle bullion coin at roughly $98 to $100 each. That's a $20 to $25 premium over spot. That's a 30% premium. But here's the insane part. While dealers are charging $98 to $100 for bullion Silver Eagles, the Mint has been selling numismatic proof and uncirculated versions for less. They were selling proof versions at $95 and uncirculated at $91. Do you understand how backwards this is? Numismatic versions are supposed to carry higher premiums than bullion. They're specially struck. They come in fancy cases. They're meant for collectors. But the Mint's prices were lower than the street price for basic bullion. Why? Because the Mint hasn't been able to keep up with price adjustments. They typically review and adjust their gold product pricing weekly. But silver has been moving so fast that their pricing models broke down. And it gets worse when you look globally. In Shanghai, physical silver has been trading above $100 per ounce, while COMEX futures were sitting in the low 90s. That's a massive premium for physical delivery over paper contracts. In Japan, premiums on secondary market platforms have surged to around 60% in some cases. 60%. That means if paper silver is at $77, people in Japan are paying over $123 for physical silver when they can find it. In the UAE, particularly Dubai, premiums are currently around 40%. In India, which imported 6,000 metric tons of silver in 2025, nearly 25% of global supply. People are fighting to get metal at any price. These premiums tell you everything you need to know. When physical metal trades at 30, 40, 60% premiums over the paper price, it means the paper price is a lie. It means physical demand is overwhelming the system. It means supply is breaking down. If you've never experienced a silver squeeze before, let me walk you through how this plays out, because we've seen this movie before, and it always follows the same script. Stage 1, sales get halted or restricted. This is where we are right now. The US Mint just triggered this. When major suppliers can't keep products on the shelf or can't price them properly, it's the first sign that physical supply is getting tight. Stage 2, premiums explode. We're already seeing this globally. As I just showed you, premiums in Asia are hitting 40 to 60%. In the US, we're at 20 to 30%. These premiums will continue widening as people realize physical metal is scarce. Stage 3, availability vanishes. This is what happens next. Dealers run out of inventory. Wait times extend from days to weeks to months. Online bullion sites show out of stock across their entire silver catalog. The only metal available is whatever's left in private hands, and those sellers start demanding massive premiums. Stage 4, the paper market loses credibility. This is the end game. When enough people realize that COMEX silver futures are just promises, not actual metal, the rush to convert paper to physical becomes a stampede. The exchange either has to deliver metal they don't have, or they change the rules and force cash settlement. Either way, confidence in the paper market collapses. We saw this play out in 2020 during the COVID panic. In March 2020, the gold to silver ratio spiked to 125 to 1, an all-time modern high. Silver crashed to below $12 per ounce. Physical silver disappeared from dealer shelves. Premiums hit 50 to 80% over spot in some markets. The US Mint couldn't keep American silver eagles in stock. And what happened? As central banks flooded the system with liquidity and people started demanding physical metal, silver absolutely exploded. From that March low around $12, silver rocketed to nearly $30 by August. That's a 150% gain in 5 months. And this was while supply was still recovering. We saw it again in 2021 during the Reddit Wall Street silver movement. Retail investors coordinated buying physical silver to squeeze the paper shorts. Premiums spiked. Dealers sold out. The Mint had to ration Silver Eagle sales to authorized purchasers. Silver went from $25 in late 2020 to $29 in February 2021, with a spike to $30. But here's what's different this time. In 2020, the ratio spiked to 125 to 1 before compression. In 2021, it was around 70 to 1. Right now, we're at 56 to 1. Silver is already outperforming gold. We're already in the compression phase. And now the Mint is halting sales. This suggests we're not at the beginning of a squeeze. We're in the middle of one that's accelerating. Now I need to tell you about something that makes this situation exponentially more serious. And it has everything to do with China. On January 1st, 2026, just 2 weeks ago, China implemented the most aggressive precious metals export controls since their rare earth restrictions. This is a game changer, and most people have no idea it even happened. Here's what China did. They reclassified silver from an ordinary commodity to a strategic resource subject to government licensing. To export silver from China, companies now need special government authorization, and the requirements are brutal. To qualify for an export license, you must have annual production capacity of at least 80 tons of silver in verified credit facilities exceeding $30 million. These requirements effectively block hundreds of smaller and mid-sized exporters who have historically supplied global refiners and industrial users. Only 44 companies received authorization to export silver for 2026 and 2027. 44. That's it. And the Chinese government now controls the flow of approximately 120 million ounces of annual exports. Why does this matter? Because China is not a small player. They account for roughly 60 to 70% of globally traded refined silver. China exported over 4,000 tons of silver in the first 11 months of 2025, while importing only 220 tons. They're a massive net exporter. And now they've shut off the tap to the West, while their domestic buyers are panic buying physical metal at any price. This is the same playbook they used with rare earth metals. Control the supply, cut off exports, watch Western markets scramble. The timing is not coincidental. This went into effect January 1st, 2026. The US Mint sent their notice January 13th, 2 weeks. That's how long it took for the impact to hit. When China restricts silver exports, it doesn't just affect prices, it affects physical availability everywhere. It means Western refiners can't source material. It means industrial users can't get supply. It means dealers can't restock inventory. It means the Mint can't acquire silver at predictable prices. Even Elon Musk publicly criticized these restrictions in late December 2025, noting that silver is essential for numerous industrial applications and that supply constraints could impact production across multiple sectors. When the world's richest man is worried about silver supply, you should pay attention. The combination of China's export restrictions and exploding global demand has created a perfect storm, and the US Mint just confirmed they're caught in it. But the story gets even more alarming when you look at inventories, because the visible supply of silver is vanishing at a rate that should terrify anyone who understands commodity markets. Let's start with COMEX registered inventories. These are the silver stockpiles available for delivery against futures contracts on the Chicago Mercantile Exchange. Since 2020, COMEX registered stocks are down 70%. 70%. In just over 5 years, 2/3 of the available delivery silver has been drained from the exchange. The London Bullion Market Association vaults, which hold silver for institutional and commercial clients, have lost around 40% of their holdings over the same period. Shanghai inventories have fallen to 10-year lows. At current consumption rates, some industrial regions have barely 30 to 45 days of accessible silver reserves. Let me put that in perspective. 30 to 45 days. That's how much runway we have in some markets before industrial production starts getting impacted. That's not comfortable. That's not manageable. That's crisis territory. And remember, this is visible inventory. This is registered, reported, tracked silver in exchange warehouses. This doesn't count unreported private stockpiles, government reserves, or industrial inventory that doesn't get disclosed. The visible supply is what the market uses to gauge tightness, and it's disappearing. Why is this happening? 3 reasons. First, structural supply deficits. Silver has been in deficit for 5 consecutive years. That means global demand has exceeded global supply every single year since 2021. For 2021 through 2025, the cumulative deficit is approaching 820 million ounces. That metal had to come from somewhere. It came from inventories. Second, industrial demand is relentless. Unlike gold, which is primarily an investment asset, silver's industrial demand has become the dominant force. Between 50 and 60% of annual silver consumption now comes from technology and manufacturing sectors. Solar panels, electric vehicles, electronics, medical devices, military hardware, 5G infrastructure, aerospace applications. Once an ounce of silver goes into a solar panel or a missile guidance system, it does not return to the market on any timeline that matters. Third, investment demand is surging. After years of underperformance, investors are waking up to silver. Exchange-traded funds have been seeing inflows. Retail buying is accelerating. Central banks are reportedly accumulating silver alongside gold, though they don't report it the same way. The combination of these factors means that every ounce of new mine supply gets absorbed immediately, and then the market pulls from inventories to make up the difference. And those inventories are now critically low. Now we need to talk about the elephant in the room, the complete breakdown between paper silver and physical silver. In the modern commodity markets, most trading happens on paper. COMEX silver futures, London over-the-counter, contracts, exchange-traded funds, bank certificates. These are all paper claims on silver. You don't hold metal. You hold a promise that someone will deliver metal if you demand it. For decades, this system worked fine. Paper prices and physical prices stayed roughly aligned. Sure, there were small premiums for physical metal to cover manufacturing, shipping, and dealer margins. But we're talking 5 to 10%, not 50 to 80%. That system is now breaking down in real time. Current estimates put the paper to physical ratio somewhere around 356 to 1. That means for every 1 ounce of real deliverable silver, there are 356 paper claims against it. 356 people believe they own that same ounce. Now, under normal circumstances, this doesn't matter. Most people never take delivery. They trade in and out of positions for profit. They're speculators, not actual users of the metal. As long as everyone is content to hold paper exposure and settle in cash, the system can function. But if even a small fraction of participants demand physical delivery, the market faces a catastrophic short squeeze. There simply isn't enough silver to meet contractual obligations, and that's exactly what's starting to happen. The evidence is everywhere. Shanghai physical silver trading at $80+, while COMEX sits at 77. That's a massive premium for actual delivery. Dealers in Japan and the UAE selling silver at $90 to $130, when paper prices say 77. Indian buyers offering $8 premiums above spot just to secure metal. European refiners seeing delivery delays. US dealers selling out of inventory. These are not small regional distortions. This is a global repricing where physical supply is commanding huge premiums over paper promises. And now the US Mint, which deals exclusively in physical metal, has confirmed they cannot operate under these conditions. They've effectively admitted that the paper price is not the real price. When institutions that deal in physical reality start stepping back because pricing is broken, you're watching the paper market lose credibility in real time. And once that credibility is gone, the rush to convert paper to physical becomes unstoppable. So what happens from here? Let me walk you through the likely scenarios based on everything we know. Scenario 1. The Mint reprices and resume sales at much higher levels. This is the most immediate outcome. Within days or weeks, the Mint will announce new pricing for their silver products. Expect substantial increases. Proof silver eagles that were $95 might go to $110 or $120. The question is whether even those higher prices will be sustainable, or whether they'll have to pause and reprice again in a month. Scenario 2. Premiums continue expanding across all physical products. As the Mint reprices higher, it legitimizes higher premiums across the entire market. Dealers will raise their prices. Private sellers will demand more. The gap between paper and physical will widen further. We could easily see sustained premiums of 40 to 60% in the US market, matching what we're seeing in Asia. Scenario 3. Availability deteriorates further. Even at higher prices, supply remains constrained. China's export restrictions aren't going away. Mine supply takes years to respond to price signals. Industrial demand is inelastic, meaning manufacturers will keep buying even at higher prices because they have no substitute. This means ongoing shortages and lengthening delivery times. Scenario 4. More institutions step back or change rules. If the Mint is having trouble, other institutions will too. We might see COMEX increase margin requirements further to dampen speculative demand. We might see dealers limit purchases per customer. We might see ETFs face redemption pressures they can't meet. Each of these events further undermines confidence in paper silver. Scenario 5. Price moves become increasingly violent. With thin physical supply and massive paper leverage, price swings will amplify. We could see silver move $10, $15, $20 in a single session, both up and down. Volatility will spike to levels that terrify traditional investors. This is what happens when markets lose liquidity and price discovery breaks down. Scenario 6. The ratio continues compressing. Silver outperforms gold dramatically. We're currently at 56 to 1. Historical averages are 65 to 1. But in past bull markets for silver, we've seen the ratio drop to 30 to 1 or lower. If gold is at $4,600 and the ratio drops to 35 to 1, silver would be at $131. If it drops to 30 to 1, silver would be at $153. These are not outlandish targets given historical precedent. And here's the kicker. Major banks are already forecasting triple-digit silver. Bank of America recently said silver could top out between $135 and $309 in this cycle. Citigroup predicts silver in the high 70s for 2026, but that was before the Mint news. Multiple analysts now see silver breaking $100, potentially hitting $125 to $150 before this cycle peaks. The US Mint suspending sales is confirmation that we're in a supply squeeze. And supply squeezes in commodities don't resolve quietly. They resolve with price spikes that shock everyone who wasn't paying attention. Let me bring this all together and tell you what you need to understand right now, today. First, the US Mint halting silver sales is not a top signal. It's a supply stress signal. Tops happen when everyone is euphoric. When your barber is giving you stock tips, when mainstream media is screaming about silver on every channel, we're not there. Most people still don't even know this is happening. This is a structural shortage revealing itself, not speculative excess topping out. Second, physical silver is now demonstrably scarce. The premiums we're seeing globally prove this beyond any doubt. When people are paying 30 to 80% over spot to get actual metal, supply is genuinely tight. When the US government's own mint can't keep products available, the shortage is real. Third, the paper market is losing credibility. Every day that physical trades at massive premiums to paper, more people realize that COMEX prices are increasingly divorced from reality. The exodus from paper to physical hasn't fully started yet, but when it does, the price moves will be historic. Fourth, time is running out to acquire physical metal at anything resembling today's prices. Once the Mint reprices, once premiums normalize at higher levels, once shortages become obvious to mainstream investors, you won't be able to get silver at $87 anymore. You might not be able to get it at $120. And trying to buy during a shortage when everyone else has figured it out means you'll pay whatever price the seller demands, if you can find a seller at all. Fifth, this is a multi-year shortage, not a temporary blip. China's export controls are not going away. Industrial demand is not declining. Mine supply is constrained by geology, permitting, and capital investment cycles that take a decade to change. The deficit is structural. That means this repricing has room to run. Sixth, silver's volatility will be extreme, but the trend is clear. Yes, there will be pullbacks. Yes, there will be days when silver drops 5 or 10% and everyone panics. That's normal in commodity bull markets. But the underlying supply deficit and the breakdown in physical availability mean the path of least resistance is higher, potentially much higher. Seventh, understand what you're really protecting against. Silver is not about getting rich quick. It's about preserving purchasing power in a monetary system that's openly disintegrating. It's about holding real assets when paper promises are breaking down. It's about having something tangible that doesn't depend on a government's solvency or a central bank's credibility. The United States Mint suspending silver sales is a historic moment. In the decades, people will look back on this as one of the clear warning signs that the silver market was fundamentally broken. You are watching a supply crisis unfold in real time. The paper price says $77. The physical market says $80, $90, $100, depending on where you are and whether you can even find metal. The Mint says they can't price accurately anymore. China says they're cutting off exports. Inventories say we're running on fumes. Industrial demand says it's only getting worse. This is not fear-mongering. This is not hype. This is reading the signals that the market is sending. And the signal is clear. Physical silver is scarce, getting scarcer, and about to reprice violently. By the time this hits mainstream financial news, by the time CNBC is talking about it, by the time your friends and family are asking you about silver, it will be too late to act at reasonable prices. The door will have slammed shut. The US Mint just showed you their hand. They cannot keep up. The system is breaking. The question is not whether silver moves higher from here. The question is how far and whether you'll be positioned when it happens. This is not normal. This has never happened before. And what comes next will be historic. Know what you hold, understand why you hold it, and recognize that we're in the early stages of a supply crisis that could define this decade. The Mint has spoken. The message is clear. The question is, are you listening?